All right, welcome back to another episode of the Tim and Tim Show every Tuesday at 10 a.m. I'm back with my favorite host, the other Tim. And this week we're talking about how our decisions evolved over time. Tim Vest was texting me this morning and had a really good one-liner. Well, hold on, let me read. I want to make sure I read it. It said, "You don't make better decisions, you stop making bad ones." And if that's a little bit of an insight into where the show's going this week, I hope you're going to buckle up and learn something this week. But as always, glad to be back here. It's been a bit of a travel whirlwind, and Tim was traveling, I was traveling, and then we had the holidays and all this other kind of stuff. So it's been busy, but I'm glad to be back in the saddle and getting back to work. So, all right, this week, Tim, where do you want to start? How do you want to talk about how our decisions have evolved over time to stop making bad decisions?
I think we just jump in, man. Think about what you and I've been talking about for like the last 6 months, right? Like just the way the markets have changed how we look at deals. And I think we've done some shows on it as well. I was on the road a little bit yesterday. I had 3 phone calls back to back, different investors, different brokers, and everything was the same. It just kind of dawned on me as I'm driving. I'm like, these conversations are different than the conversations I was having 2 years ago, right?
Hmm.
And then, 2 years ago, it's just like, what's your buy box? North and South Carolina, really? Right? No, that was kind of it. Like multifamily in North.
Wait. Are you talking about when you're talking with a broker or an investor?
Broker.
Broker.
And
Okay.
yeah, and it's like, what's your buy box? North and South Carolina. Just send everything to me. I'll figure it out from there, right? And I think we did, but over time, that's evolved a little bit, those conversations. And it's like, if it doesn't cash flow 7% day one in place with today's debt, then don't send it to me,
Yeah.
that kind of thing. If there's operational upside, that's great, but I'm not paying for it, right?
Right.
Those kind of things. And I think I think that's a good place to just jump right in, right? Like that's an evolution that's taken place just in a short time, like 2 years, right?
A lot of it's experience, but it's also a lot of market sentiment change, right?
Right.
Now, if we were the only ones having that sentiment change, it'd be one thing. But the market as a whole, I mean, that's why brokers are asking, like, what's your cash flow requirement now instead of what's your buy box? What markets are you buying in? What vintage are you buying in? What's your debt structure look like? That what are you trying to achieve? What's your mindset on how you're underwriting your deals? Those are the types of conversations we've been having, or at least I've been having with brokers as
So
well.
my,
So that,
so- Sorry, my only challenge to that would be is it I mean, yeah, it's a market sentiment change, but why is it a market sentiment change, right?
right.
Because people have learned hard lessons over the last 3 years,
Yes.
right?
Yeah.
Um,
Yeah. And I mean, there's so many people now that are not doing this anymore. I mean, I
oh
think
yeah,
there's a lot of different stages of your investing career, and most people fall off pretty early, after they get excited about buying deals, and then they grow and scale, and then things get hard and everybody quits.
yeah.
I mean, I'm not gonna lie to you, that has shaped a lot of our decisions lately. Is learning of all those people that have dropped off and just kind of moved on and said, "This is hard. I'm not making money anymore. What else can I do?" Right? And then that is what has spurred a lot of the conversations and a lot of the questions that we ask. Right? Because we just don't want to go through that heartache and that pain all over again.
Yeah, and yeah, and honestly, I was talking to one of our friends, who's a broker that we consider a friend, and we were having some of those same conversations. Like he mentioned a couple of guys. He was like, "Hey, have you talked to this guy? Have you talked to that guy? Do you know this guy?" And I'm like, "Yeah." But no, I haven't talked to those guys in a while, right? Or yeah, I know that guy. I saw he's doing something else.
Hmm.
We had a very specific conversation around that. But Tim, I think one of the things that's been kind of like big for me is things that we were saying yes to 2 and 3 years ago because of the operational upside. We're kind of looking at that now and going, I hear you, and I see the operational upside, but I'm not paying you for that opportunity, right?
Hmm.
And we had a number of deals that we did over or a number of years that was that was cost basis related, right? We knew the cost basis was good. We knew there was an operational upside, and we could get there, and we did, right?
Mhm.
But looking back on it, I'm like, those deals are fine, guys. Don't get me wrong. We're not getting ready to tell you that we lost some $100 million portfolio or something like that. That's not what we're saying. What we're saying is we worked our asses off to realize that operational upside, guys,
Mhm.
and it paid. It did not pay generously. It did not pay the level
No.
of effort involved for what it paid. The juice wasn't worth the squeeze, if I'm being honest with you.
Yeah, that
And
man, that is too true.
yeah, and I think we no longer stopped making bad decisions, right? We're making better. We're not making better decisions. We stopped making bad decisions,
Less
and
bad ones.
yeah, and I think that's where this goes. And like Tim, you and I both know, like there's someone that we bought a lot of deals from, and we're looking at that person now, and we're like, it's not that I won't buy anything from you. I'm just not doing it like this anymore, right?
Yeah,
Like
right.
this is what my criteria looks like, and if we're willing to come to the table over that kind of criteria, where you make a little bit, we make a little bit, our investors make a good chunk based on this, then we can do a deal.
Yep.
But we're not doing it like this anymore, right? Um,
Yeah.
and it's not that we're just making less bad decisions, right?
Yeah.
If
Yeah,
you-
I talked to you about this deal when you were traveling, but I was having a conversation with a friend of mine, and he was looking at doing a deal, and it was a motel conversion, and generally we just stay out of those. But it was like, Tim, you got to look at this, like look at the basis, look at this, look at that, look at the location, and all of those things. At the end of the day, I started going through the underwriting, and I was just like, "Oh, have you considered this? Have you considered that? Have you, I see what you're underwriting. For example, it was underwriting to like the voucher numbers, and I was
yeah,
like, well, what happens if that voucher leaves? He goes, we'll get another one. I said, what if you don't? And then I was like, so that, he was like, told me what the number was. And I said, well, that's what you got to underwrite to. And, that was a lesson that we had learned,
yeah,
and kind of have changed our underwriting to, by past experiences, was like, just because you can get a voucher doesn't mean it increases the value. It
oh
increases
yeah,
your cash flow for that moment in time, but the true value of the property is still underwritten to the lowest common denominator, which is what can the market bear,
right,
right? And even if your vouchers are higher than what your market can achieve, does not increase the property value, right?
yeah,
5 years ago it did. Everyone was like, "Oh, look at all the cash flow it makes. Apply a cap rate, and boom, you're on your way." But banks have smartened up. Agency lenders have smartened up. We ourselves have smartened up.
yeah,
And learned some of those lessons along the way. But it's just less bad decisions because we've seen a whole lot more, right? And
yeah,
the more we continue to niche down in our market, niche down in our asset class and type, but also our markets, it just continues to get easier and easier and easier to say no to things.
yeah,
Somebody sent us something either last night or early this morning. I didn't look at the timestamp, but I turned around, underwrote it in 20 minutes. I sent it back to Tim Vest, and I was like, I don't see how this works.
yeah, right,
Because I didn't have to look up any information about the property because I just knew it.
right.
It's just interesting to see how things have evolved and changed ultimately.
Yeah, man, you bring up that voucher thing, and that was actually a conversation I had yesterday because one of the guys I was talking to, he was pitching me on like the voucher stuff, and I'm like, man, I was like, I'll add it to the cash flow. I'll put it in when it factors to cash flow. I'm not putting it on value, and I'm certainly not going to count on it for refi. And
Mhm.
and one of the things that Tim, you and I were talking about before the show today was I hope this works, versus, what would cause this not to work, right? And that's an evolution of the decision making that we're talking about as well, right? It's like, hey, vouchers, right? That's great, let's put this in there, and when we go for refi, let's hope this helps with the value, right? But then you start thinking about it, you're like, well, what would cause it not to work? Well, now that you've been through a few, hey, I can tell you what would cause it not to work. Lenders could base what they give us credit for. they could change that, right? And
Yeah.
I can't control that, right? It always comes back to like, what can control versus what I can't control. And I think as you get more experience, as you get a few trips around the sun in this market, you start to realize like, hey, at the end of the day, if I can't control a variable, I'm not counting on that variable. I'm just not going to do it, right? And
That's gambling.
yeah, that's gambling. That's hope, right? Hope or
Hope.
gambling, and neither one's a strategy, right?
Mhm.
And at the end of the day, it's kind of what one of the brokers and I were talking about yesterday. I was like, man, listen, like I think North and South Carolina have shown it with the tax abatement stuff. Like you can't count on it. Like if it's there for now, that's great, but don't count on it being there forever. And the second piece with vouchers, man, like the lenders aren't giving me credit for it, so I'm not factoring it in when it comes to what I'm willing to pay you.
Mhm.
And that's ultimately what it comes down to. And that's a maturation of our decision making over the last 18-24 months, right?
Yeah.
Um,
Yeah, the South Carolina tax abatement thing, when that first started getting really popular, and I remember you and I having a conversation about it maybe 2, 3 years ago, and I was just like, Tim, we can't, if
right.
somebody else has to apply for it, we can't assume that that expense is going to be factored into our NOI, and we got to add it back in.
Yeah.
And people were looking at us like we had four eyes.
Right.
They looked like we were crazy. And I was like, what are you talking about? There's, to your point, there's no guarantee that it'll be around again. And then you get the argument, well, it's always been there. And I was like, yeah, but now it is so popular, it's shining a light on it, and everybody's paying attention to it. They're going to come in and change it, right?
Right.
And then why would I pay you for the uncertainty of potentially not having to pay property taxes? Like, if that program goes away, which the government can do at any time and say, not happening anymore, even though
Yeah.
you're already approved, you're part of the program, they can nix it immediately and be done with it. And you have to start paying those taxes again. So it does not increase the value. You may be able to realize some cash flow increase over the period of time. But at the end of the day, you can't underwrite that. Now, here's one thing that one thing I want to say that I'm focused on now, that I'm acutely aware of as an acquisitions, kind of being in acquisitions mode, is I'm looking for people that are trying to sell stuff from their tax abatement strategy because their market rate rents are under where they can be, because naturally they have to be 80% or less of the AMI. So there's potential there to increase the rents. And also we need, we're not going to factor in the tax abatement, right? So not only are you kind of securing, hey, we're going to add back in the tax abatement, but we're also knowing that the business plan restricted their rent and there's going to be natural rent increase for us.
Yeah.
Right. So that's acutely aware of like, hey, I'm going to pay attention to that deal a little bit more because there's some value add built into it right out of the gate.
Yeah. And and I think I would also say, one of the other pieces that kind of comes along is over time, like you start to see things, right? You start to, it's not so much that you know the answer as much as you recognize a pattern, right? Like, and I think lending has been one of the biggest ones for me, right? Because back in like 06 and 07, I saw some things going on with lending that at the time I'm like, this gravy train's going to go forever. Lenders are making money. We're making money. It is happy times, right? And then 08 and 09 rolled around, and then all of a sudden you're like, where'd all the lenders go? Like, what happened? And today, it's not the same thing, but you are recognizing some patterns, right? You're like recognizing that, hey, lenders are getting more conservative. Lenders are being less judicious, right? I mean, or more judicious. And there's things there where you're kind of like, I'm seeing a pattern, right? I'm seeing a pattern. And what I know from the last time I saw this pattern was time was my friend, right? So if I have a lender that's willing to work with me, that's going to give me time, all I know is I don't know when this market's going to change. I don't know when a shift's going to come. I don't know what rates are going to do, but I do know that time helps. Mm-hmm. So what I learned back then was time's my friend. Don't put yourself on expiring debt or immediately expiring debt, and go buy yourself some time. And, guys, that's been like the theme for the last 12 months for Tim and me, 18 months, hell, is like, let's go put these things on stabilized debt. Let's get on a 5-year horizon here, and let's see what the next 5 years brings.
Yeah. I've been saying, let's pull our heads up in 5 years and see where we are.
Yeah.
We got, I mean, we do. Keep me honest here. We've refinanced 8 properties since December,
Yeah, I think that's right.
right? I think it's
Yeah,
been 8.
yeah,
Most people don't refinance 8 properties in 2 years, and we did it in 6 months, right?
yeah,
6.5 months.
yeah,
I mean, it has been super stressful, not only on us, but also on our team, right? I mean, we
yeah,
have been hard on our property managers and our director and regional manager to accomplish like occupancy goals and collection goals and, all of that kind of stuff, which we needed to do in order to get to our refinance. But now it's like, okay, keep it full, keep everybody happy. Don't, go wild with the rents. We're just paying attention to our bottom line
yeah.
here. We don't want to lose all our money to vacancy and turn costs. We're not going after the rent increases anymore, right? We're keeping it full because the mindset is let's wait it out. Let's keep it full. Let's not expose ourselves to more risk of turnover risk. And I'm praying it's a whole different world out there. What's that movie like Reddick or whatever where they go underground and then they
Yeah,
come back up and it's like a whole new world out there or whatever.
right.
Hopefully it's like that. But we are actively trying to acquire more deals, and the inbox has been growing with potential distressed deals. But as this stress looks different on every single deal, so kind of like how in 2020 everything was a value add. Right now everything's is distressed. Right, it's like what's a catchphrase or a keyword or
Yeah,
like one of those
yeah,
words that everybody says to get your attention type of thing. But like just because it's distressed doesn't mean it's a good deal. Case in point, the deal I underwrote this morning does not make it's a good deal because the other
right.
the other guy assumed he might have been able to get $4,000 a month rents and they're only getting like $1,895 or something.
That's a big miss.
Big, huge miss. So like but it makes it so much easier to say no to stuff, right? It's like I'm making less bad decisions. I'm not as excited about deals as I once was. Like you really got to twist my arm to get me to sign up to take on the risk of a new deal. Like you have to
Yeah,
prove to me, why I should buy this from you. And that's a really good feeling as a buyer because, that gives you the control and the power to kind of dictate the terms and the acquisition strategies and all that kind of stuff.
yeah, and correct me if I'm wrong, but I know from not wrong. Correct me if you disagree. I Part of my stance on how these decisions have kind of changed too is just a personal piece, which is like I'm not willing to do that work
Oh no.
or that
Duh.
repair.
Whew,
Right?
that's the best way to phrase that is I'm not willing to do that again.
Yeah, yeah. I mean, and we've had a couple of those. It's been like,
hmm
hey, they were profitable, and it came in, and you and I looked at each other and went, all that for this?
Right.
Really? I'm like, I could have done so much more
Yeah.
and done way better. Um,
Yeah. But at
um,
the time we made the decision, we were like, well, it's fairly low risk. I mean, it was no financial risk to us because we
right.
had no financial risk to it. It was time and effort, right? So
This
sweat
time and effort.
equity.
Yeah,
Right.
100%. Or you think about it, it was like, hey, instead of that, I could have been doing this, or instead of that, we could have fine-tuned operations even more, right? Or something.
Right.
I mean, there's always a time trade-off, right?
Always.
But hey, one of the things I did do is right before we got on, I jotted down a couple. I was like, what are a couple of things that and how did they pivot, right? And um, I think one of the big ones, right, like we're talking about, is like we used to say what's the upside, right? And I think now we're asking a little bit more, but like what's the downside, right?
Yeah. Yeah.
And
What's the
then
downside on this deal?
here's one you and I have had a lot, which is how much rent can I raise, right? Like
Mm.
that was the old one. And then, but now I think it's more like, hey, what happens if I can't raise the rent, right?
hmm
Or my favorite is how much money can I raise? Oh, but what happens if I can't raise any?
Right.
What do we do? Like that's been a real one lately. And
Yeah.
then,
Yeah. The deal size, the appetite for the deal size has definitely gone down, right? Because the
right,
scalability of capital raising has changed.
right. And then you'll like this one because man, you've thrown this one out a few times. It's like instead of the what's the IRR question, it's
Mm.
like, hey, what's my margin of safety, right?
Yep.
Like forget IRR. Like,
Mhm.
what's the risk level look like?
Right. IRR is a fancy, pie in the sky number, but what's my in-place cash flow and debt coverage ratio? Tell me that.
Yeah, yeah,
You
and
know?
then yeah, and then last one that I had, just because we've been through this one so much lately, is will the lender approve it? That was the old question. I think today what we're saying, hey, what happens if they don't? Um, and
Yeah. Yeah, man, we've dealt with some hairy lenders.
yeah,
Uh,
yeah,
Tim Bratz, when I was in San Diego, was talking a lot about lend to own, lend to own banks. And let me tell you, those lend to own banks, they're, I mean, they'll keep you up at night, man. Like
yeah,
whew, and then, they'll say, "Well, I'm protecting the bank." I don't know, man. If there's another P word I'd like to use there, but it's not. I don't really want to say it, but it'll keep you up at night, right? I mean, but thankfully we were able to get what we needed to done because
yeah,
we have a level of urgency to get it done. But the sometimes the level of urgency is not reciprocated, and it really puts you in a bad spot, a little nervous spot.
yeah. Man, I think one of the things that, kind of thinking about this today, kind of got to me was, I remember when I first went from, it was real easy for me when I was flipping, right? Like I was just flipping what I could see around my daily drive, right? When I got into multifamily, for whatever reason, my head went to the country is my opportunity, right? Like everything
Hmm.
around. And but then I realized, I was like, man, when I dial it in, I get better. And I started to do more deals as I fine tuned my area, right? And
Hmm.
I think that's kind of coming. I think that's kind of a metaphor for like just my overall investment strategy. Because the one thing I was thinking about was like, man, as I've gotten more experienced, the smaller my investment universe becomes, right?
Hmm.
And you kind of mentioned it a few minutes ago. It's like we don't do hotel conversions, right? And there was a point in time when I was like, I think you remember, like we had that event down in Atlanta,
Hmm.
and there was a guy up there talking about hotel conversions, and you and I drove away. We were like, man, we need to look at some of those,
Right.
and now, but we never did one. But today we're like, "Yeah, we don't do that." And there's a
Yeah.
number of things where we're like, I don't do that. I don't do that.
Right.
I don't do
Right.
that. But like 3 years ago, 4 years ago, we're like, hey, we should look at
Maybe.
maybe, right?
Maybe.
Yeah. But it just reminds me, like as you get more experience, like I think, my markets tightened,
Yeah.
my the type of assets I'll do tightened. It all kind of tightens and
Hmm.
fine tunes, right?
Yeah,
Um,
it's a lot easier when we're talking with brokers and we're like it's got to be one of these, Charlotte, Hickory, Southern Pines,
yeah,
Florence. I would like to do something in Myrtle Beach just because it's closer to me, so because I can get to it in an hour. But I'd be open to something in Myrtle Beach, but those are like our core four markets,
it's it's funny. One of the brokers I was having a conversation with yesterday, he actually asked me. He was like, "Would you guys look at Myrtle Beach?" And I was like, "I was like, funny you should ask."
Yeah. I would like to. Myrtle Beach is a difficult market because it's so long,
Yeah,
north to south, very long. And there's a ton of hotel conversion and like short-term
yeah,
rental and all that kind of stuff that we don't mess with. There's
right.
not a lot of like traditional multifamily. I mean, there is, but there's not. If that seems weird to say, but like there's a lot of it, but doesn't seem like there's a lot of opportunity for it, if that makes any
Yeah,
sense.
yeah,
Same with like Wilmington. Like Wilmington's got a lot of multifamily, but making the numbers work here is impossible, right? I mean, especially with what we're chasing now. If you were an appreciation investor and you didn't care about cash flow and you wanted depreciation, sure, that works all day. But at least what we're looking for and what our investors are looking for now is cash flow, and that doesn't really work in a very, very, very small, high demand market, right? Operating on very compressed cap rates, even compared to Charlotte and Raleigh, our cap rates are lower than Charlotte and Raleigh here in Wilmington. But
yeah,
the either way, it's just a lot easier to say no to stuff when it crosses your door. And I mean, I'll, out of respect for some of the brokers, I'll, because we're friends, I'll look at a deal and just give them an
right.
offer because it helps them out. But at the end of the day, like if it's not, in those markets where it's I can drive to it and get back in the same day type of situation, I really am way, way less interested in it.
Yeah.
Any of this overnight stuff, I'm like, I'm good.
Yeah, it's funny because you're all around like something that I was thinking about earlier is like, when I was younger investing or earlier in my investment career. Because guys, when I'm saying younger and older, I'm not actually mean like 20 versus 50 or anything like that. I'm just talking about experience in general, regardless of when you gained it. What I was thinking about was like, hey, when I was a little bit less mature investor, I always thought investing was about saying yes to opportunity, right? And
Mhm.
as I've gotten older or more mature with it, like you're saying, I've realized it comes more in the form of like saying no,
Mhm.
right? Like smart investing's more about saying no than it is about saying yes.
Mhm.
And that's a mindset shift that I think it took me a little while to fully understand.
I know, and it sounds like, yeah, I'll say this all the time because it's a very cliche saying, right? And say
Sure.
no more than you say yes, but like you don't get it until you get it,
Get it. Right.
right? And it's like you can look at all of these, cliche sayings and Facebook posts and memes and all this kind of stuff, and the words, but you don't internalize and comprehend it until it's like, you've been through it type of thing. It's a really weird predicament to try to explain or like,
Yeah.
kind of support, but it's like when right? When like the people in our circle now, that we talk to and I'm asking them questions, they're just like, nope, nope, nope. And they're just like, yeah, we say no all the time now. But like 5 years ago, it was like, yes, 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 yes.
Yeah. Yeah.
you know?
Yeah, I'm with you, man. I am, again, it's one of those things, and you and I kind of had some conversations about this recently. It's like, just some things that have happened over the years. I'm like, I'm seeing that. Like, I'm seeing that tendency again, right? And I just want to avoid it. I want to stay away from it.
Yep.
What what's the what's the what was there was I had a mentor one time that kind of gave me a quote. I'm trying to remember what it was. Something to the effect of like confidence comes from surviving mistake, wisdom comes from remembering them. And
Confidence comes from surviving. With wait.
confidence
Say that
comes
one more
from
time.
confidence comes from surviving mistakes. Wisdom comes from remembering them.
Oh, remembering them. Yes.
Yeah,
Yeah. Okay. Yeah.
yeah.
No. I like that.
No, no. You
No.
okay, Ed?
No.
Ed's saying no.
Yeah.
Um,
Yeah. No. 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 Yeah. That's our favorite word now. The
yeah.
answer's no. Now, what's your question? It's not. Geez. Now I sound like my dad.
Answer's no. Now, what do you want?
Yeah.
Um,
The answer's no. What do you want? Oh yeah.
uh,
Hope maybe he'll see this. He just was here for the weekend and he flew back last night. So, uh,
so,
kind of funny. But all right. Well, hey, I think that this kind of is a good stopping point for this decision. This is a good decision. uh, I think we talked about a lot of things of how we've matured our investment criteria over a period of time, some lessons that we've learned, some real life examples of how we've applied it, right, which is important. But as always, we appreciate everybody joining the call and watching this, whether you're watching it live or later, and comment in the Facebook group or on YouTube, and let us know if you have any questions, and we'll do our best to reach out and answer them for you. So, without that, we'll cut it here, wrap it up. All right.
see you guys.
Peace.
Peace.